Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 12th of the 12th, 2023, December 12th, and Brent crude oil is trading at up this morning in Asia, up at 76.55, up 0.5%. A slightly upward draft this week after testing the lower half of the 70s. Started the correction, if you like, last Friday and has slowly but surely some momentum today or this trading week. Two big events in the world right now that, as they used to say in the Vatican, waiting for the white smoke. COP28 in the final hours, debating whether to include some reference to phasing down, phasing out fossil fuels. Meanwhile, in China, the standing committee of the ruling Communist Party is meeting to decide what the target growth rate will be for next year. This year, of course, it was 5%, a sort of unimpressive 5%. The rest of us would be begging to have 5% growth. Meanwhile, China's 5% looks like a damp cloth for some reason. Let's kick off this morning with somebody who spent most of their last 2 weeks at COP28, Laurie Hitayan, MENA Director, Natural Resource Governance Institute. While we're still trying to identify where anything that comes out of COP is relevant to the oil and gas markets, we still are quite interested to know what is your thoughts on what that outcome is. What are they fighting over in these last minutes? Laurie, your thoughts on this sort of final negotiation window for COP28?
So good morning to all, and I was happy to be in Dubai, and now happy to be back to Brussels. Basically, like, we knew that this was the fight, the battle, like the mother of all battles, about like the language that will come into the text on the future of fossil fuels. Was it like so? And from the beginning, from the first day, there was, like, from the presidency, signal that we should be flexible, we should be agile, we should be innovative in the language that we use, and open to it without losing that 1.5 degrees. So kind of basically balancing between those who are like very conservative on how we get to 1.5 degrees and still like keep 1.5 degrees alive, and those who think that we should be there is still a role for fossil fuels, and we should take that into consideration. So basically, there will be a great news at the beginning, loss and damage fund. That was like a big deal that everyone wanted to hear from. So first day, that announcement came as very big, and then and since then, nothing major has come, if you want. And we knew that the battle was happening around the text. The text came out yesterday, and many people are not happy, at least like around the climate activist clans, etc. They're not happy with what they're seeing. Very, very relaxed language on fossil fuel. And then that's that's the battle. Like, they
And
haven't
in
seen.
order to get to a communique or a declaration document, whatever its official title is, does there need to be 100% consensus of every member state of the United Nations?
Look, I don't know. I'm not like I'm not the negotiating. I'm not into
Yeah,
negotiations, and
yeah.
I don't know much how these things happen. But I think like there are last minute now at the ministers level to come to a kind of an agreement on the text. Especially there is this uh, um, provision 39, if you want, in the text that talks directly about like the fossil fuel. This is where some changes uh, people want to see, like stronger language on phasing out and phasing down on fossil fuel, which they see that now it is a very relaxed text that caters to everyone's needs. So you have on tripling renewable, doubling on energy efficiency. Then they talk about consumer and producer responsibility. Then they talk about inefficient or subsidies, which I think like these are things that in maybe like it is the text, and when you read it, is favorable to the resource rich countries, at least in our region, the
Well, I
way I
suppose
see it.
at the end of the day, it's what we call in multiple choice land, all of the above. All of the above. E. Fill in E, all of the above. Everybody wins. Everybody can go home. But the German foreign minister has said they will not be signing off on it, and the European Union will not be signing off on it. And happy to stay in Dubai and enjoy the sunshine for a few days more. Let's see how it transpires. Meanwhile, David Fife, chief economist at Argus Media, the Chinese are facing a big decision where to put the dart in the dartboard for economic growth next year. We got a 5% target, is the strange sort of way the Chinese do things. They set the target and then set the economy to reach that target. Most of us do a GDP in the rearview mirror. What did we achieve last year rather than what we're going to achieve next year? But this is the Chinese way. They set the target for the economy. What do you think they're thinking of? What do you expect their target to be?
Well, good morning, and thanks very much for having me on. Yeah, I mean, I think China's probably broadly on track for this year to hit the target they set for themselves of 5% GDP growth in 2023. Our expectation is that for next year, probably they can hit something maybe around 4.5%, something like that. I think the key element that they must be concerned about is, first of all, the real estate sector, which is a quarter of the Chinese economy, is really struggling. The authorities have very much squeezed liquidity for the real estate sector. And the issue there is that the consumer, many Chinese consumers have much of their life savings tied up in property. And therefore, consumer confidence is going to struggle to come back if the real estate sector continues to struggle. They've also got a fairly weak RMB at the moment. And that means that the sort of levers of stimulus that the Chinese authorities can deploy to try and goose growth a bit higher are a bit limited. They don't want to open up too wide a differential between interest rates in China and those in the US because of concerns about capital flight. So they're in a bit of a bind, but we would expect probably a number that's a bit below 5% for next year.
Salah Yilmaz, senior energy equity analyst at Bloomberg Intelligence. Salah, the sort of big story in recent weeks for the direction of oil markets travel has been the OPEC policy decision, the OPEC plus decision recently to double down on their cuts, increase them into the new year to sort of counter the possibility of there being a build up in inventories in the first quarter, which would be a seasonally weaker demand window. Do you think OPEC Plus has it done enough? Is the market slowly but surely coming around to their thinking and giving them that upward draft in the oil price we've seen in recent days?
Good morning, Sean. Thanks for having me. So I think I don't think they could have done more. I mean, they've kind of agreed on deeper cuts. They've agreed to extend them. But you're right. I think it's been unconvincing to the market. It's been met with some serious skepticism by the market. I think a lot of people and a lot of analysts are thinking that these will be mostly paper cuts. They will not actually result in actual cuts, especially by some of the smaller OPEC plus uh, member nations. And then it's we will have to see. We will not know if these will be enough or not. As you say, the first quarter is usually a low demand, seasonally low demand period. But I think generally there are some significant oversupply concerns between now and the second quarter, and this is mainly because of, as you know, surging production from outside the OPEC plus group, especially from the US. And I remember on this call earlier in the year we were talking about US production, and I was saying that spending there, we shouldn't expect it to go up that much, and we shouldn't expect too much output growth. And I remember you challenged me on it, and I should admit that you were very much right on this. And we definitely did get this quite wrong on how much non-OPEC and especially US, how much marginal output they could bring this year. So with that in mind, with surging US exports that we're seeing, it is a difficult position for OPEC Plus. again, looking back at the last meeting, I don't think they could have done much more. The discussions are, I think, getting more and more difficult because a lot of member nations don't want to cut anymore. And Saudi Arabia, the de facto leader, they're already doing quite a lot of heavy lifting as well. So I think they're in a difficult position. But then we will have to wait and see how the demand picture looks in the first quarter. Again, we don't expect it to be too strong, but we will wait and see. But as we stand, I mean, Brent at $76 a barrel, WTI 72. More importantly, it's a contango structure now all the way through the middle of next year. So it's giving us a lot of bearish signals. But I think OPEC will just have to wait and see what the demand picture looks like in the beginning of next year.
Laurie, just turning to Middle East geopolitics, we've seen in recent days the Houthi militia out of Yemen causing troubles in the shipping lanes of the Red Sea. Other activity starting to sort of the return of what was a standard sort of recurring disruption of the shipping lanes around the Red Sea and the Arabian Sea in recent years, really. And the southern border of Lebanon, the border with Israel now starting, it would appear, to heat up a bit more than that somewhat contained dance of the last 2 months between Israel and Hezbollah. Are these signs that this war in Palestine, this invasion of Gaza, it's starting to spread now? Is this what spread looks like, or is these separate corridors? Because these are bubbles that are always bubbling under their own steam.
Well, not escalating at all. Like, I still believe that Iran is seeing the benefit of being very calculated in this in the response to what's happening in Gaza through its proxies. So definitely the Houthis are doing what it was expected from them to do, which threaten the Red Sea and threaten any passage of goods or any ship to Israel, to put pressure on Israel, especially on the Eilat port, where some of the essentials are going through. Even if they're even if it's now we see like diverse kind of ships that are being stopped or diverted, but this is the kind of signal to Israel of Houthis' presence and therefore Iran's upper hand when it comes to that corridor. At the same time, with the Lebanese borders, again, Hezbollah very calculated for months now, since the first day, since 8 October, the Lebanon through Hezbollah was involved in the war, but still contained and very calculated. Now we're hearing that Israel is asking the French to get involved, and then for French presence on the borders, on the Lebanese borders, with the Lebanese army and with some presence of Hezbollah to guarantee the borders, and on the Israeli side to have the US present. So now they're starting to talk about post-war and post-war settlement. So that means that there is no escalation. On the contrary, we're heading into discussion about the future. And we've seen the group of the Arab countries and the Islamic countries that is led by Saudi Arabia, who's touring the world to talk about the ceasefire and most probably the future of this war, how to end, and what will be the future. At the end of the day, today, there is no disruption that is really impacting the prices of oil, but definitely with the economic malaise that we are seeing around the world, with wars like between Ukraine and the war in the Middle East, all of these, I don't think like we're entering into the new year with like good signs that there will be like economic growth, etc., etc. And I think that is what's putting pressure on the prices. But at the same time, I guess like entering into 2024, the only way, if we want to talk about politics and the region and beyond, I think it's like the US, EU, China, and the Gulf countries led by Saudi Arabia need to sit around the table and discuss about ending this war in the Middle East and finding a solution for the Palestinians, for a Palestinian state that is a viable Palestinian state. I think that is going forward could at least give a good sign that there will be a bit of a positive note for entering the 2024, or else with what we have today, 2023, 2024 doesn't look good at all, neither in politics, neither in geopolitics, neither in on economic growth.
David, the other big event happening this week is the central banks are having their sort of last meeting of the year, which was sort of predicted to be a fairly non-event, that we'd already come to the end of tightening, that it was all about when we were going to start cutting now. Your thoughts on what impact or relevance these final meetings of the year could have, signaling to the new year and relevance for the markets?
Well, I mean, I think for several months now, there's been a bit of a divergence between what the market has felt about the future trajectory for interest rates through 2024 and actually what the central banks themselves have been saying. And to be fair to the central banks, they've been fairly clear that, you know, they've been pushing the higher for longer message in terms of interest rates. In other words, yes, we might be close to peak interest rates in the Atlantic Basin, but don't expect us to start cutting anytime soon. And I think probably the nail in the coffin for early US interest rate cuts, was the November jobs report, which, had unemployment falling. So that was really showing that the jobs market in the US is still running pretty hot. And I suspect there may be some messaging that, reinforces the fact that we shouldn't expect the US to start cutting rates anytime soon. Now, Europe's slightly different. Arguably, European GDP growth in the fourth quarter is probably going to show a second consecutive quarter of modest decline. So arguably, Europe is already in recession. And therefore, the ECB may be prompted to begin cutting rates a little bit earlier, perhaps sometime in the second quarter, or more conservatively towards the middle of the year. So, but I suspect the Fed is going to hold fire. And I suspect they really want to see some more protracted slowdown in the jobs market in the US before they'll even start to think about cutting rates. And that could even be well into the third quarter, I suspect.
Do you think they will signal that today, or tomorrow when they meet? Do you think you'll get some, given the market has gone so far forward of the Fed, there's now a gap. Clearly, the Fed is being led by the nose. The market's saying cuts, and many of them earlier next year.
Well, they've got to be fairly careful about what they do in terms of messaging. I mean, we're all talking about when are they going to start cutting. We shouldn't neglect the tail risk that actually, if you get, significant uptick in supply chain pressures, you have the Panama Canal basically reducing traffic. If there was an uptick in attacks on shipping using the Suez Canal via the Red Sea, you're talking there about significant supply chain pressures, which could kick in. We don't think that is the base case scenario, but clearly you could have an uptick in inflation, and that might mean that the Fed has not finished tightening. So we shouldn't neglect that as a non-negligible tail risk for the market.
Salah, one of the big topics of the year, and then as you mentioned in your earlier comment, was the recovery in U.S. oil production up to near record levels. And also through the year, we've seen some major acquisitions. ExxonMobil spending $60 billion to acquire Pioneer, and then Chevron, $50 billion on Hess. And then overnight, we see Oxy spending not as much, but acquiring the Permian Basin production company, Crown Rock, which would be Oxy's second acquisition of this sort of 4 year period. They purchased Anadarko. I suppose the combination of both Anadarko and Crown Rock would put them in a similar price range of spending as Exxon and Chevron. My point ultimately is now that these three very large actors are in the Permian controlling the shale, do you expect they will continue to spend money as they did, as we saw the growth in production this year, to expect a continuation of that next year?
I think so. I mean, these mega deals by the U.S. majors have shown that this is increasingly a priority region for them. It's a short cycle, quite good in volatile oil price environments. And I think we've seen this kind of consolidation cycle in the U.S. as kind of a signpost by these U.S. oil majors, uh, as their confidence in oil demand growth and kind of which puts them in a clear divergence between against the European oil majors, where what we've been hearing, and this is something we discussed on this call before as well, on how kind of deprioritizing oil production growth and kind of increasing transition spending. And then this kind of further widens that gap, I think, between the US majors and European majors. But then I think the interesting point there is what's also diverging is the valuation. I mean, there's this significant valuation gap between the US majors and European majors now, that seems to be widening. So I think the interesting point for me there is that if the European majors are looking at what the market is signaling, where the US majors doing some mega deals, prioritizing oil M&A, prioritizing oil production growth, and seeing their valuation at a massive discount to these US majors, it could be signaling to them that perhaps they need to slow down their transition spending, or they need to prioritize once again oil production growth, which is, I mean, obviously not great news for the energy transition itself. So it's been interesting to see the mega oil deals that we've seen this year in the US. It wasn't too surprising, but just kind of reaffirmed how the US majors are very much still committed to oil production growth. And I think there might be some signals from that to some of the European peers.
Let's go to the survey question and get a view of the China outlook. China obviously hovered a lot over the energy markets this year. We started the year as I went to IP week in February. I mean, you couldn't find anybody who didn't say it will be the year of two halves. The first half will be blah, but China will come back in the second half and, like Superman, save the day. Superman never arrived, but as most people in this room, or at least David, seem to signal 4.5%, 5%, they're still going to hit their target. And that was known at the beginning of the year that China had set 5% as the target. Everybody said, Yahoo, year of two halves is going to be great. So even if China sets another target of 5% next year and we get a similar outcome as this year, is that bullish or bearish for the markets? Another 5% target. 5% didn't seem to deliver too much fireworks this year. 5% next year. Will the oil markets see that as bullish or bearish or no impact? That's the question. Bullish, will China's 5% target be bullish, bearish, or no impact? Laureatean, you and all of your new countrymen in Belgium would be biting your hand off for 5%. Now that you are a European,
Yes.
and not that you didn't live in Paris of the Middle East, in Beirut, and will always be the Paris of the Middle East, but nonetheless, you mentioned in your earlier comments Europe's sluggish growth, maybe even in recession already. And my thoughts, having been away and come back from the COP and back into Europe, what does Europe's outlook look like for next year? Is this going to be a bit like the Fed rates? They're going to be, plateau for a long time, that this could be a long recession, a kind of low impact, but sort of stagnant growth for Europe. China at 5% feels like stagnant growth, you know. Europe at 0% feels like more of the same. Your thoughts for Europe's outlook? Have we seen the worst?
Look, I think still, like, don't forget that the Europe has like the war that is happening in Ukraine that is having an impact on their economy, and the attempt to still contain the war and to support Ukraine. That is a lot of financial and other kind of support. So that is very important for them. And on the other side, this energy transition and making the green transformation, these are like the two things that Europe is preoccupied with. These are like the two things that are pushing them. And as long as we see that the German economy is struggling because they had been the hardest hit by the Ukraine war. At the same time, they are the ones pushing for kind of this green transformation, green energy. So I think looking at what's happening in Germany will give you a sense of what is happening around in Europe. But definitely, these are the two things that are really like the heavy burden on the shoulders of the European Union. And going forward, we will have like in 2024, the elections, fear of the right wing coming into the European Union. What does that mean in the European Parliament? Because we are seeing like these rise of the right wing in the national elections. So how this will impact the European Parliament. Therefore, what kind of a European Parliament are you going to have? Will it be something that could push for decisions to go forward, or there will be like other sorts of policies when it comes to energy or when it comes to other sort of things? So these are the things that Europe is preoccupied with, and definitely waiting to see what kind of winter we have. Don't forget that we are under that pressure as well about like, is it going to be a warm winter or a cold winter, and what will happen to the gas prices? All of that is something that Europe is so much like taken with.
A lot to digest there. David, your thoughts? I mean, particularly we're coming to the sort of into next week, into the sort of holiday season. I mean, I don't like to use that word at a time when so many in the world are facing such challenges, but inevitably the end of the year is a distraction period for the markets. It's the festive season in much of the world. What bearing could that have, do you think, on the direction of travel of this market over the coming weeks? Shallow trading volumes and such things like that in a market that has, although a bounce at the moment, a somewhat downward draft in it. What are your thoughts over this festive month, if you like, the markets travel?
Well, you're right. I mean, you know, the end of the year, it's traditionally a time when people try and minimize tax liability to a certain extent. So there's a bit of a downdraft of potential impact there. On the other hand, we have the geopolitical elements feeding in, as we've talked about extensively today. And clearly, if we continue to see attacks on shipping in the Red Sea, this really opens up the potential for a further squeeze on supply chains. Net, that could be relatively supportive. So I guess I'm sort of hedging my bets and saying we may track sort of sideways where we are presently. But I think first quarter is going to be key. I mean, our numbers show if OPEC Plus members deliver the cuts that they're talking about, that should be supportive in the first quarter. We think there's a significant 800,000 barrel per day stock draw in the first quarter if they deliver the entirety of the cuts that they're talking about. But of course, the big question is if they deliver. And I think the key point there is, there was no official OPEC Plus communique about who's going to cut what. It was all about individual countries announcing their voluntary cuts for the first quarter. And that sort of tells you that, there's maybe a little bit less than full buy-in by all members.
Yeah, it does feel like it's going to be an agreement that will be rewarded, quote unquote, in the rear view mirror once it's delivered rather than promised. The Salah, we see the market, the voting is no impact, a little bit divided, really. The outcome, the China growth target. Your thoughts of this coming month? We're going to, the podcast will be off as well at the end of this week. What do you think the direction of travel is? I mean, if you get more sort of commentary from OPEC plus and uncertainty, it might, not be a market to short going into the holiday season.
Yeah, I mean, I would echo what's been said already. I would say steady and range bound between now and the end of the year, unless we get a significant announcement, such as OPEC Plus doing an emergency meeting and saying they'll cut more, which is unlikely, I think. And of course, all the macro indicators, I think from China, we will get an indication on how much stimulus to expect for next year, for example. And I think with the central bank meetings, as you mentioned this week, I think we'll get like just new clues about the likelihood of any potential interest rate cuts next year, which, I think the rate hike cycle this year arguably has been one of the biggest overhangs on oil prices. So we'll get some clues on what to expect on that, but I don't think any of these potential announcements will be significant enough to move prices substantially. So I would expect prices to be range bound in the next few weeks.
Range bound to the next few weeks until there's some new direction of travel. That could come this week. That could come commentary from the Fed or otherwise to indicate tightening for longer, or to sort of push back against the market's over optimistic outlook. I mean, over optimistic in the sense that for rate cuts, but in order to get rate cuts, you'd have to have serious economic slowdown. I mean, the rate cuts that are being forecast, 4 or 5 rate cuts next year, that would be nearly like a deep recession kind of outlook. I suppose the next question is ultimately, what is the neutral rate? What is the neutral interest rate that doesn't, support the economy but doesn't slow it down? It used to be around 5% where we are now. Is it still? The markets would indicate no, it's lower, but maybe it's not. We'll have to wait and see. These are all the indicators. We're going to kick off and see oil prices trading up a little bit today. Brent crude oil. Laurie Atayan, thank you so much for your comments and insights today. Have a great holiday season, and thank you for your contribution. Salah Yilmaz as well. David Fife, a great festive season to you all. We look forward to catching up with you in the new year. We will kick off, of course, with our annual Global Energy Outlook Forum, virtual around the world, 12 hours crystal ball forecasting on January the 10th. Please join us then. All the best. Thank you.
Thank you.